This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I am Scott Norse here with your Forex Report, wrapping up the week. Today is Friday, August 10th, 2007. Well, don't look now, but the dollar might actually finish the week in positive territory. Amid what seems to be a crisis in the U.S. mortgage market, the greenback has gained against most of its major counterparts. Why? The recent meltdown in mortgage-backed securities has led to a global risk aversion that forced a sharp unwinding of carry trades. In the midst of this chaos, yen cross pairs slid much faster than the dollar-yen, thus allowing the buck to rebound as well. There are no big economic releases from the U.S. this week, and in fact the biggest event was the FOMC rate decision on Tuesday. After leaving rates at 5.25 as expected, the Fed offered an accompanying statement that may have been a little more hawkish than some traders were looking for, saying inflation remained its predominant concern. Of course, this has not deterred futures traders from betting on rate cuts, today pricing in a 33% chance the Fed will call an emergency meeting this month to lower rates. Some even expect the FOMC will cut by 50 basis points to help financial markets weather the storm. We do not agree with this expectation and think these traders must have forgotten that Bernanke, not Greenspan, is steering the ship these days. Majors and crosspairs have been incredibly volatile all week, and we have been urging traders to seek only short-term trading opportunities until things settle down a bit. As it stands now, we are not trying to forecast prices even a week out, as new developments in the credit crisis are hitting newswires almost daily. Technical levels of support and resistance are helping to guide the market some days, while other days have simply been erratic and unpredictable. We still think that it will be some time before the dust truly settles and traders begin seeking riskier investments again, which means we will proceed at least into next week with our active trading approach. Now to the big picture. Well, as we know, it was another very interesting week in all financial markets as the credit crunch that began with U.S. subprime mortgages continues to spread. Not only is the credit crunch spreading to other mortgage types, but geographically the problems are also expanding. Hedge funds at Bear Stearns Company were some of the first to halt redemptions of clients' money, but now we are seeing the same from funds in Australia, Europe, and the UK. BNP Paribas, France's largest bank, this week said it could not allow redemptions in several of its funds that were invested in U.S. mortgage-backed securities. Central banks in North America, Europe, and Asia have all added liquidity to banking systems by the billions in the last 2 days to help keep lending rates between banks at target levels. The ECB lent an additional 150 billion euros, more than double what the bank added on September 12, 2001, the day after terrorists caused the World Trade Center in New York to collapse. This signals to traders that this is a major problem globally, but also sends the message that central banks are prepared to help where they can. As long as this high level of uncertainty and panic remain the theme, we do not see high-yielding currencies rebounding significantly, and carry trades may unravel more. This means the dollar could find further buoyancy in the near term, but look out below when the dust settles because the greenback may spiral lower. Till next week, have a wonderful weekend. Take care.